Why are interest rates going up and inflation is going up? Prices keep on going up, even with Federal Reserve central bank action against these prices. What's happening? Why? I think the Federal Reserve is befuddled. They don't know why they've increased rates successively and inflation keeps going up, even accelerating. Have you noticed it at the store? You go to the store, everything costs so much. It's called the Gibson Paradox. Gibson, 1926, published an article in a banker's magazine that basically said, contrary to logic, when interest rates go up, prices go up. When interest rates go down, prices fall, or at least inflation falls. This is contrary to the quantity theory of money or the quantity theory of credit. You would think that when interest rates go up, there's less credit out there. This tapers demand. When demand is tapered, by the laws of supply and demand, the price level will start to ease back. That's the playbook central banks act on. And in fact, this was a paradox noted by S.B. Saul, who tried to explain the Great Depression of 1873 to 1896. But he couldn't do it. Alfred Marshall also noted this. He started to just basically talk about the peace dividend or exogenous factors that we can't explain. And John Maynard Keynes, in his normal convoluted, almost nonsensical economic logic, also tried to explain it, but he couldn't. Bring in economic genius, Knut Wicksell. 1898, interest and prices. He said the interest rate that you observe, that everybody talks about, central banks, is a relative rate. It's relative to the natural rate of interest. The natural rate of interest simply is the profit rate, or the expected profit rate. Now, Wicksell wasn't the originator of this theory. He rediscovered it, let's say. There was Henry Thornton in the 1700s. He had a very similar idea of a mercantile profit rate in relation to the interest rate. And I believe Thomas Took was aware of Thornton, and he was trying to explain this Gibson paradox of high interest rates and high inflation. So what does that economic theory mean for today? Bring in economic genius Knut Wicksell, and I can tell you exactly what that means. It means the Federal Reserve has not increased rates high enough. If the profit rate is, let's say, for example, 50%, and interest rates are 10%, I'm going to go to the bank all day long and take out a loan through financial arbitrage, make a windfall profit. And this is what is happening. Maybe not in such an amplified discussion of nominal rates versus the real rate versus the natural rate, etc. Maybe it's like the profit rate is, according to the Bureau of Economic Activity, don't quote me, is about 7-8%. And interest rates may be 2-3%. Still, this is an incentive to economic agents and entrepreneurs to take out loans. When you take out loans, you bid up prices of scarce resources. When you take out consumer loans, you bid up prices of consumer goods. The CPI goes up, the PPI goes up, the PPC goes up. Whatever index you measure it by, even if these are inaccurate measurements, which I believe, they dampen the effects of the story of inflation. You're still going to have inflation. So what should the central banks do? What if I was in charge of the central banks? Besides shutting it down and putting us on the classic gold standards, then I have a better idea. If you follow economic genius Knut Wicksell, he might say, increase it to the expected profit rate. If the expected profit rate, according to the United States Statistical Bureau of Economic Activity, is 7.5%, 8%, 7-8%, push interest rates to 8%. And then you're going to see inflation stop. Then you're going to see economic money macroequilibrium. I mean, when I was a kid, Volcker pushed interest rates to like 21%. So when Powell pushes interest rates to 2-3%, I'm just going back to do my work on my greenhouse back here. It doesn't do anything for me. It's almost a joke. Interest rates have to match the expected profit rate, or you're going to have a cumulative process, in the words of Wicksell, of perpetual inflation. And it's not going to stop. It's going to continue ad infinitum. There may be other elements that will put a drag on it, and some inertia on price level increases, which are independent of the natural rate versus the bank rate of interest. But according to theory, that goes back over 100 years, time-tested theory, inflation will continue. Inflation has to continue because the motive of profit incentive for entrepreneurs is to borrow low and make a profit high. So there could be, what is that inertia on prices that could bring us down to a lower price level? Well, it's simply increases in productivity. If productivity increases, even if the Federal Reserve doesn't raise the natural rate or the actual bank rate to the natural rate, inflation could taper and calm down. And productivity, there's a school of thought in GDP, and this is nominal GDP targeting, that believes productivity should move inversely to prices. So the higher the productivity, prices should start to fall, even without all this natural rate and nominal rate discussion. And in fact, Wicksell was aware of that. David Davidson, in the 1800s and 1900s, really, early 1900s, had a polemic. They went back and forth arguing if productivity affected the price level independent of the natural rate framework. I believe, and it's in the appendix of this book. This was 1898 book, but in the appendix, the English version, according to Carl and you can read it very carefully, Wicksell started to concede this point. So there is hope. This is a great story of hope, I think, on my channel, even though I have to tell it like it is. Even if the Federal Reserve does not continue to increase the interest rates, if productivity increases, inflation can start to taper. Do I think personally that will happen at this juncture? I'm skeptical. We have a lot of things that dampen productivity, particularly in Europe, which I'm not going to mention. Wicksell noted that after, and so did David Davidson, that these things, what's happening in Europe, can hurt productivity, and therefore it can actually increase prices, or at least slow the growth of productivity. So we're going to see what's happening. But I do know that the Gibson Paradox is in play right now. Increasing interest rates, increasing inflation. That doesn't mean anything great for me because I'm basically under the premise that I don't operate with consumer debt or even business debt. But it is relevant for me and probably for you when you go to the supermarket. You may say, okay, well, wages are increasing, but real wages are decreasing because wages tend to lag behind prices. And that's another story. But there it is, the Gibson Paradox, and brilliantly explained by Knut Wicksell and myself to some extent. Increasing interest rates, increasing inflation. Decreasing interest rates, decreasing inflation. Thank you very much.